Surveys showing that instead of investing in the stock market, younger investors are investing in this instead. What is it? Is it something you should consider? That more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. At the moment that I'm recording this, NVIDIA has recently passed Microsoft as the most valuable company on the planet. And I saw the headline, you might have seen this as well, that if you had invested 10 grand into NVIDIA during its IPO in 1999, it would be worth $59 million today. That 10 grand would be worth $59 million today. I think, guys, this truth, when there are these outliers like that, it just ruins us as investors. And if we focus on those, it's really hard to have a healthy approach to investing. And NVIDIA, that's not the only example. Obviously, you could have said the same about Apple, investing in Apple before the iPhone came out. Or you could consider even Mark Zuckerberg's story, not even being an investor in Facebook, but a college student thinking, what if I did this? Even on YouTube here, on this platform, you think of Mr. Beast, you think of Dude Perfect and others. As the internet age, and I don't know if there's a better way to phrase it, but as over the past 10 years or 15 years, there have been these outlier examples of people or groups of people that have gotten in on something early or exploited an idea early and have made an unbelievable sum of money. And I think that truth, that yes, there are these outlier examples, are making it very difficult or potentially creating some really unfortunate trends or not helpful trends for investing, especially in younger generations. Okay, so here we go. Recently, some data came out by Bank of America where they looked at 1,000 high net worth individuals with 3 million investable assets or more, excluding their primary residence. And here's what the survey found. 72% of younger investors, so between the ages of 21 and 43, I'd call those young investors, yep, believe it's no longer possible to achieve above average investment returns by investing solely in traditional stocks and bonds. I'm going to come back to that. These words matter, okay? I'm going to come back to that. Versus 28% of investors who are over 44 feel that way. This is born out of the portfolio composition. So get this, stocks comprise only 28% of these younger investors' portfolios compared to 55% for older. Well, what could be taking its place? Goes on. Younger investors are shifting their allocations to alternative investments, including cryptos, which comprise 31% of young investors' portfolios compared to just 6% for older investors. So if you reverse engineer all those words and those numbers, young investors, categorically, 31% of their overall portfolio is in alternatives, including crypto, whereas it's just 28% in the stock market. For younger investors, they are, on average, okay, heavier weighted to alternative investments like crypto and overweight that compared to the stock market. So another article referencing this survey where it talked about collectibles as well, not just crypto, but collectibles like classic cars or wine or other alternative type of investments like that, not just crypto. So why? At least the author of this article kind of dates it back to, well, of course that younger investors would feel this way because they've had a really rough road with traditional investments. I'm going to come back to that, but take a look here. The millennials witnessed 2 big market corrections in their formative years. I would agree with that. I actually was in college and had recently graduated, became an advisor during the tech bubble, right as that was happening. And then, of course, just a few years later, walloped with the 2008 great financial crisis. The author at least suggests, well, that's partly to blame why investors or younger investors maybe are hesitant to invest as much in the stock market. I would argue, though, it also comes back to where I started. That just there are countless examples. There's just lots of examples where someone got in on something early and fast forward and they ended up making a lot of money. And I think for younger investors, they look around and they look and say, if I haven't hit not even a home run, if I haven't hit a couple grand slams, I'm not investing correctly. I think this is dangerous. This is a dangerous approach to investing for the long term. Now, I'm not saying that doesn't mean that you shouldn't have some alternative investments. I actually think you should, and we help clients with that as well. You might be familiar, our overall investment philosophy is making sure that your investment strategy is tied to your long-term financial plan, your retirement plan, and what you're investing for. But then that long-term approach, your investing strategy, needs to be multiple strategies. There needs to be diversification on top of diversification. If you are just diversified between US and international, large and small stocks and bonds, typically those are going to, there might be a time when all of those move in the same direction at the same time. So correlation, it seems, at least among equities, has been growing. And therefore the benefits of diversification seem to be lessening. Therefore, you need to have different strategies as well, and those could be alternatives. However, so I wouldn't abandon alternatives, but I would get them in the right proportion, and do fear that because of, I would call, recency bias, or just seeing some of these outlier examples, I would caution you and younger investors from disproportionately weighting too much of their portfolio on these alternatives as opposed to the overall stock market or traditional investments. And here's why. Those other investment categories don't have as long of a historical perspective. They don't. And the reason why I'm going history is because no one knows the future. We don't know. And anyone that predicted COVID, I'll have them tell us, the best investment, because no one could have predicted that, and therefore no one can predict whether NVIDIA will stay on top, or whether its returns will be lackluster, or if it's the next Cisco. No one knows, right? But historically, well, what does history say? The history for Bitcoin even goes back to 08, so it's not very long. However, the stock market, even just the S&P 500, goes back 100 years. So in that nearly 100 years, going back to 1928, the S&P 500 has averaged an annual return of 9.9%, so just under 10%. But if you sort of kind of cut through all of that, take a look at this chart here. This is directly from Morningstar, the S&P 500 index, and the date that I did the research, did the recording, so I could show you. Obviously, this changes all the time, but the 1 year, 24%, I would kind of throw that out the window. That's very, very short term. 3 year, 9.61%, because yes, younger investors, we saw the tech bubble, then shortly followed by the great financial crisis. We've also seen COVID, which has its own mark in the history books, the fastest decline ever, the fastest recovery as well. So just 9.61% over the past 3 years. But 5-year return, 13.46%, 10-year return, 10.86%, 15-year return, 12.66%. Here's why I struggle with the author's take that, well, younger investors, they've just seen too much. It's just been too much of a bumpy ride in the stock market. Therefore, investors are looking for something else. Guys, younger investors have actually seen the US stock market outperform the long-term average, and that long-term average is pretty fantastic. So to me, going back to that survey of asking folks where you can get above average returns, I think that's a poorly worded question. If you go to the market, you are going to get expected average returns, so you've got to take more risk, or try to hit some grand slams to try to get above average. I think it's a poorly worded question, but the data that younger investors are holding more alternatives than they are stock market, you really can't argue with that. To me, guys, I wouldn't downplay having diversification and holding some alternatives. And so I'm not going to give you a direct recommendation. You got to work with your certified financial planner on that. But I like having some of that exposure. To me, I would have your base investment approach be with traditional investments, and I would complement that with alternatives. I'd have the base be traditional investments. I'd complement it with alternatives. Said differently, I would build out that financial plan, working with your CFP, and whatever you're investing for. Most people, it's financial freedom, financial independence, being able to retire and step away from that paycheck someday. I'd have that being accomplished from my regular contributions that are going into into traditional investments. Maybe you're adding in real estate as well for income producing and alternative source to income, that sort of thing. But then I would have play money, extra dollars invested in those other alternatives to help complement it. And again, why? Not because I don't believe in those alternatives. They might be and may be the way of the future. However, when you look at what I can expect, have they gone through, how many recessions have they gone through? How much overall kind of change have they experienced and endured in the overall economy? Nothing compared to what the stock market's endured. And yet, despite all of that, we are in a season where we've seen above average returns. And yes, things could change for the next 6 months or the next 2 years. We might see a big downturn. But again, that's already baked into the past 100 years as well. And the average rate of return being just under 10%. That's fantastic. So I would have that be the base of your investment approach and investment philosophy, and have the alternatives be play money or a complement. One of the biggest, in fact, you could argue the biggest, most important financial decision that you're going to make in your life is your asset allocation. It's this mix. It's getting this right. And I wouldn't want you to invest one way really speculatively, just everything. I'm trying to hit a grand slam. I wouldn't want to over invest there and then all of a sudden show up later in life in your 50s or so on thinking, that didn't materialize or didn't quite get the traction that I wanted, and now I've got to play catch up here where time is working against me instead of working for me. Work with your certified financial planner. Get that recipe right for your situation. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.